live via YouTube and will also be available for viewing after the meeting. So I have received apologies from Councillor Sue Waddington, who will be joining us online. Before we move on, I'd like to make an announcement. I'd like to put on record the committee's thanks to Chris Tambini, who is retiring after more than 6 years as Director of Corporate Resources and involvement with the pension fund since 2011. Chris has led and overseen significant changes to the fund during the last 11 years, which has seen a 139% increase in the size of the fund from 2.3 million at March 2011 to 5.5 billion as at December 2022. This was as a result of careful stewardship, employer and employee contributions, robust investment returns, and the support he provided to the local pension committee. Chris's careful stewardship was so well renowned that in 1 year, no members felt the need to turn up to the annual general meeting. A bit worrying. He's worked with numerous chairs of the pension committee, including Brian Page, Graham Hart, Peter Osman, and myself. Only Councillor Graham has outlasted him, so well done, Malise. During these past years, Chris has overseen pooling with LGPS Central in order to drive down investment costs, improve responsible investment standards, and prudentially manage the overall funding of the scheme. Chris oversaw the fund's first steps into pooling 5 years ago when LGPS Central was set up, and the fund as at December 2022 is now considered 50% pooled. The fund also, for the first time, joined the Local Authority Pension Fund Forum and started us on a journey of leveraging the significant responsible investment resources at Central and managing climate change with reduction of the fund's carbon intensity since 2019 of 26%. Finally, in line with the growth of the fund mentioned previously, the fund is in a much stronger position based on the latest triennial valuation, with 105% funding level, a significant improvement from 9 years ago, where the funding level was 72%. I hope that members can join me in wishing Chris well in whatever opportunity he takes up in the future. Congratulations, Chris, and I'm sure all members join me in wishing him well in the future. Yeah. He looks far too young to be retiring. Okay. So the first item that we've got on the agenda is I propose that the minutes of the meeting held on the 20th of January are taken as read, confirmed and signed. Is everyone in agreement? Yes. Yep, they're agreed. Question time. We have received questions from Mr. Bill, which will be taken under item 9. Questions asked by members under standing orders. As I said, we're receiving them under item 9. To advise the chair of any items taken as urgent, I've not been notified of any items of urgency. Declarations of interest in respect of items on the agenda. Does any member have any interest they wish to declare? No, it's fine. So the first substantive item on the agenda today is we have the Partners Group Private Debt Management Update. I believe we have Mr. Chris Bone, Mr. Joshua and Louis Hoffman with us here today to present this item. Bulesh, our senior finance analyst, will first present a short introduction and then we'll take the presentation for Partners Group. So over to you, Bulesh.
Thank you, Chair. I'll be as brief as I can. The purpose of the report is to provide the committee with information on the fund's investment settled with the Partners Group. We will get a presentation, as the Chair just mentioned, representatives of the group. Just a quick bit of background on what our private investments you've got in your packs, points 3 to 6. But in short, these are loans that the investment manager Partners extends to companies to be senior and secured. Senior debt is the debt that a company must repay first if it goes out of business. Secured debt is backed by an asset such as buildings and or equipment. It's worth noting that at the January 2023 committee meeting, the 2023 strategic asset allocation was approved. The allocation to private debt was held at 10.5% of total fund assets. And at 10.5%, you can see it's a fairly critical part of the fund's strategy. Point 8 and 9 overleaf. Private assets, they are diverse and take together with a 10.5% target. The fund has employed a number of managers. Partners Group are one of those. Point 10 in the table, you can see the other managers we hold in this space. So we have LGPS Central, and we've got a number of investments with them. Got Christopherson, Robb and Company, couple of investments with them totaling 69 currently, and M&G, where we've got 3 funds which are in runoff now, totaling about 64 million. Point 11 talks about where we are versus that 10.5% target. So as at the 31st of December, total value of private debt funds were at 407 million, so a little short at 7.4% of total fund assets. It is worth noting that there are significant uncalled commitments with LGPS Central. The most recent commitments were approved at the subcommittee in October. We committed 140 million to LGPS Central's low return vintage and 80 million to the real assets vintage. Partners Group can talk more about their strategy, so I'll skip over point 12, which talks about the most recent vintage. And then in point 14, we've got a kind of history of the funds that we've invested with the Partners Group, reaching back to MAC 1 back in 2014, all the way over to MAC 7 recently in 2022. As ever, we've asked Partners Group to cover a number of areas within their presentation, 15A to D. And at that point, it's probably a good point to hand over Chris.
Thank you for that, Mr. Goodman. Eagle-eyed observation. So, over to you, Chris.
Super. Do you want to say a few words?
Absolutely. Good morning, ladies and gentlemen of the committee. Thank you very much for having us here today to talk to you a little bit about Partners Group and the investment mandate that you have with us. I think in the first instance, I'd also like to thank you for being a valued and trusted investor with us for a number of years now, and also for your most recent commitment into the 7th vintage of our multi-asset credit series. Conscious of the limited time that we do have, before we dive into the materials, I'd like to give a brief round of introductions on our end. My name is Louis Hoffman. I'm a part of the UK client business. I'm joined here today by Christopher Bone, who leads our European private debt business, as well as Joshua Wood, who's a senior member in our private debt business in Europe. Maybe Chris and Josh, you'd like to say a few words quickly?
I don't have so much exciting things to say about myself. 12 years at Partners Group. Before that, another 12 years working in industry. Yeah, I've got 12 years of industry experience and have been working in the private debt markets during that whole time. So, yeah, very pleased to be here.
Yeah. In that case, I'd like to focus on slide 4 in the first instance to give a brief recap of the firm. As you know, we are a global leading private markets business headquartered in Zug, Switzerland, where we were initially founded back in 1996. Since 2006, we were listed on the Swiss Stock Exchange. An interesting fact about that is that every Partners Group employee is a shareholder of the firm, making us the largest shareholder group of the business. And 2 crucial elements of this is, on the one hand, this creates a strong alignment of interest between ourselves, the employees, and yourselves, the investors. But what it also does, it instills a sense of entrepreneurial spirit within the firm and us employees, that we act like business owners in our day-to-day investment activities. Looking at the firm today, we have roughly $135 billion of assets under management, which is exclusively invested in private markets, that is private debt, equity, real estate, and infrastructure. To do this, we have over 1,800 employees located across 20 offices in the world. Of that employee base, over 500 individuals are dedicated investment professionals with the sole task of sourcing and executing on the best possible investment opportunities within their relevant asset classes. Focusing on the middle section of the slide here, you can see we have one of the largest and most stable and experienced private debt teams across the industry, with close to 100 investment professionals and an average experience at the senior level of 23 years. As you can see, we are strategically located across North America, Europe, and Asia Pacific, and that is that we are able to source and execute on the most attractive investment opportunities within those areas and ensure that we are able to allocate capital in line with our global relative value views. What it ultimately means is we seek to identify the sectors, the industries, and the regions that at any given point in time offer up the highest relative value. And we focus our effort, our time, and our capital on those areas. Now, there are just two more things I'd like to highlight about our private debt team, which really give us a differentiating factor amongst our peers. On the one hand side, it's the portfolio management function, in-house portfolio management function, that are responsible for the construction of both client and fund portfolios that adhere to investment guidelines, but also have an adequate level of diversification throughout. And the second point I'd like to highlight is the workout team, or the restructuring team that it might be more commonly known as, which is an in-house team dedicated towards maximizing the recovery as well as the value of potentially underperforming assets within the portfolio. And in the market environment that we've experienced over the last 2 years, this is an invaluable team to have within the context of our wider private debt team. With that, I'll hand over to Christopher Bone, who'll give you a little bit of our private debt experience and how it fits into the construct of our firm.
So private debt, will you describe what private debt is? And just a little quick reminder, it's always good to compare it to what it's not in a way. So private debt compared to public debt means that we don't buy and sell debt on an exchange. It's not on Bloomberg. You don't buy a piece of debt on a Thursday and sell it on a Friday. You have to originate it, remake the loans directly to the borrowers, to the companies that we like. And we're often the sole lender, or perhaps one of 3 or 4 lenders to a company. And today our private debt business is about 25% of our overall business at Partners Group. So it's a very important part of the business. Now, what has the market been doing? On the next slide, well, I think, look, it's been quite a complex background for us in the last certainly 6 months. We've seen rising inflation, both wage inflation. We've seen energy, of course, costs rising, and those topics impact the companies that we lend to. By and large, though, I'm very pleased to say is that our portfolio has been quite resilient to these. That's mainly because the companies we lend to are profitable companies, strong companies that are able to manage these rising costs. And you see on the chart on the bottom right here what it says EBITDA growth or earnings growth. And even since the COVID period, actually the companies have continued and see a strong growth trajectory. So we're very pleased with the overall strength of the portfolio. The other topic, though, on the next slide is the base rates, interest rates, rising dramatically in the last 4 or 5 months. So the good news for your portfolio is that your returns are structured as a margin over the base rate. So that means that when we lend to a company, we will typically charge, say, 5% margin plus whatever the current base rate is. And so back in July of last year, we were typically getting about 5% because interest rates were close to 0 in Europe and in the UK, under 1%. Today, of course, though, the returns are, well, the base rate is today 3 or 4%, depending on whether you're in Europe or the UK. And so you are receiving the 5% plus the 3%. So you are protected, what we call from inflation or from higher interest rates. And that's a positive of investing in private debt as an asset class.
Yes, if you flick over to slide 8, you can see the sort of result of what Chris is saying in the current market context we have today. And what we're seeing is returns at a decade level high. Obviously, there's a differential in interest rates between Europe and the US. You can see on the left, that's the US market. You've got 5% plus interest rates there. And in the European market, we're projecting here for 2023, 3.5% interest rates. But you're looking at double-digit sort of return numbers, which are the highest level they've been in a decade, like I said. In terms of actual margins, Europe versus US, the levels are fairly similar. So the margin is the spread that you actually receive in coupon income. And then another nice feature of the private lending market is the original issue discount, which is essentially an arrangement fee that you receive for arranging the loan. These have been very solid in the current market environment. You can see there that's 1% at the top. And that's a nice sort of contributor to returns. Generally, that's slightly higher in Europe than it is in the US. But the US market has seen a bit of an uplift there. So overall, it's a good story in terms of the return environment, and we expect that to continue. If you go on to the next slide, please. This is our current European senior debt pipeline. So these are the sort of deals that we're seeing in the market, and it's across Europe. We're covering the entire continent, as Louis mentioned. The pipeline is positive. We are seeing a slight slowdown, as I'm sure you're all aware, in the M&A environment. So there is a sort of slight reluctance for companies to seek financing or sales processes at the moment. So we're seeing our deployment slightly lower than it has been in sort of comparable times, but we're expecting that to pick up in the second half of the year. But I think the metrics that we're seeing are very good. So one of the nicest themes we're seeing here is that leverage on businesses has been going down recently. Clearly with these interest costs at 10% plus, businesses are being careful in terms of the amount of debt that they're putting onto themselves. So you can see here, leverage now is down at around 4 times in deals we're seeing in the market. The margins are at 6% plus. And then another good feature of the market at the moment is documentation is better than it has been in recent times. We're seeing better covenant protection. We're seeing tighter controls on businesses, which is good for the debt that for the loans that we're making.
So I just wanted to recap a little bit about what your strategy that the fund that we manage on your behalf is, and that's on page a couple of slides ahead. So we are lending to sizable companies with revenues of at least 500 million plus. These are not SMEs. These are not growth companies or startups. These are companies with often 1,000 employees. Often they are global companies in their own right. Peter's mentioned it. We are lending to senior debt. That's first ranking debt. So if things go wrong, you're the one that grabs onto the table first, right? And sells what there is. So you are the first to recover capital. That's important from a risk perspective. You are investing in a global mandate, and this is an important point here because I know there are questions around whether we invest in local companies to lesser share or more globally. We do source, actually, and we'll talk about one investment that we supported locally here. But our mandate is to be diversified. We want to reduce the risk that you face, and by doing that, we try to go global. We try to go many different sectors, so that if there is a default, you don't really feel it in your portfolio. We are typically backing not distressed companies. We're not backing companies in turnaround. We're looking for what we call sleep at night companies which have been resilient for 10, 15, 20 years, which are in a strong market position, strong brands. So we're at the lower end of the risk spectrum when it comes to the debt financing that we look to achieve. On the next slide, it's a little summary of what you have done with us over the year. Just to summarize a few key numbers. So in total, you've committed with us about 470 million pounds. We've returned to you already of that 274 million. So you received back from us about 62% already from what you've committed. And that, and Bill mentioned it, you originally committed to what we call MAC1 or multi-asset credit 1. And that one, for example, is almost 100% returned. And what you've done is we're going to MAC2 and MAC3, they invest 100%. And then over the few years, as the loans are repaid, we repay those loans back to yourself, plus any interest that has been accrued over that time. We promised to you about a 4 to 6% return, and we're running at 4.8% today on a blended overall basis. So we're pretty much bang in the middle of what we said we would do in the beginning. On the next slide, we show like what we call the Ayers Rock, we describe in our terminology. So we invest in the first year. We want to make you fully invested in the first year. So typically 90 to 100% of your capital will be called. We recycle for 1 or 2 years, and then we unwind. And that's what we try and show. And each of the vintages that you have are at different stages of that investment cycle. With MAC1 being the one at the far right, 7 years in, you're 110% distribution. So you've already received 100% back of what you've committed, plus 10% extra, and we'll just we call harvesting the last bit of the portfolio. Now, what I was supposed to do in a few minutes is just to dive quickly into the individual funds that you have. I start with the most recent one, which is the multi-asset credit 6. Here we are 94% called. It's in the early stage. It's really one of what we call just finishing the investment period. And even, which we can turn to the next slide. One thing I want to talk about straight away is that of all the loans in there, we have 75 loans. They're all performing. We don't have anything what we call on our watch list. A watch list is when you move things, when they start either breaching covenants or underperforming versus budget or versus prior year. We move them onto what we either call an under review, which is our amber list, or a red list, which is the risk of loss, where we think, oh, okay, things we may need to enforce or take the keys or the like. So for Mac 6, your most recent is 100% performing. You're fully called and you're invested in 75 companies, really well diversified across many different sectors. And it's 95% senior debt, so first lien senior secured. On the next slide, Mac 5, and actually we can also turn to the following slide quickly beyond that. Here's the first one where you see that we're 98.8% in performing, and we have 1.2% of the portfolio, which we classify as on the watch list as the red item. What is this company? Is it important to understand? This is a payment service provider in Germany. So this company provides services to, in UK, if you put your card into a machine and you tap in your number, they handle the point of sales of the things. It hasn't done such a good job. The reason why it hasn't done a good job is it had some exposure to retail and to travel, and that has reduced particularly recently. And so they get a fee for every time some consumer spending is spent or they travel, and that reduction is fed through into their revenues. We think we'll be okay here, but if we're not, it's 1.2% of the fund, so it's not going to impact materially how the fund performs. Again, well diversified by over the regions and by sector. And if you go beyond that, Mac, I was going to dive into one example here, Legentia. It's always good to bring it to life with 1 or 2 examples. Josh will talk about one example in a moment about a local company here to which we're backing. Legentia is one that we just invested quite recently. It's a UK company. Just to describe what it does, next time you order a fridge from John Lewis, for example, and you wonder where has this fridge come from, often it will come from the Far East, China, Taiwan, and the like. Getting that fridge from China to the store in UK to John Lewis and then to home to you requires quite a lot of logistics around that. It's a lot of management of supply chains. And this company, Legentia, helps companies like John Lewis and the others manage their supply chain. It can be managing the paperwork. It can be managing, is it going by boat? Is it going by plane? How is that goods transported around the world? In the current market environment, it's attractive because the supply chains around the world have been disrupted, partly from COVID, but also more recently as a result of Ukraine. And so there's been a bottleneck in the global supply chain market, and this company, Legentia, tries to help companies manage those complexities. So it's we're one we're very proud about. Maybe on the next slide, you can, I might have been this one. It's so in each of our loans, we try to align the incentives not only to returns, which is of course most important, but we also try to embed what we call sustainably linked metrics or ESG metrics. We try to make the companies think about how they are performing on environmental or social or governance topics, and we incentivize the company by putting in what we call a margin ratchet. We charge them 5 bips more if they're not doing a good job, and we reduce it by 5 bips if they are doing a good job. So, for example, in the case of Legentia, we'll be looking at how well they're managing fleet costs and transport and fuel, and we incentivize them to be better at managing that. And if they are, then they get a little bit cheaper cost of capital. It's a metric, we have it in about half of our loans in Europe at this point in time. We try to in all of our loans, but not all companies there yet are willing to accept it or willing to do that. But it's something we're pushing in. It's very topical at this point in time.
I think just one other comment there is that in the European market, we're actually miles ahead in terms of these ESG ratchets. The US market is really lagging, but with our positioning and as Louis mentioned, our sort of global scope, we'll really be at the forefront of driving what will become a trend in the US market as well. If we go over the page, this is a business we've been lending to for a long time, since 2017, called Access Group, which is one you might all be familiar with. It's one where Leicestershire County Council were building essentially the offices at University of Loughborough, which I think was quite a large project. It's a HR software provider to companies. We've been backing the business since 2017, so we were the first direct lender in what was a bank-led transaction, and then the business since then has had a series of add-ons and a mixture of sort of M&A driven growth and organic growth. You can see here it's had very, very strong revenue and earnings performance over time, and the business has grown substantially in size since we first invested with it. And why did we like the business? It has a very good financial track record. The business has been hitting targets every year, even with this aggressive growth plan it's been following. It's got a very good and strong diversified customer base across both Europe and Asia as well now. You can see here 20,000 individual customers and 75% recurring revenues. That was closer to the point of transaction. If you look at that now, it's more like 60,000 customers and 90% recurring revenues. So it's very sticky recurring revenue business, which is what we like in the debt space. It's very integral to these businesses as well. The software, it's very hard to sort of once it's embedded, I'm sure you'll know what that's like once you've got your software and it works. The only real time that customers are being lost are when businesses are effectively closing down or going out of business, frankly. So it's a very, very sticky customer base, and it's a business we like very much. It's backed by really good sponsors who we've got very strong relationships with. It's a senior investment, as Chris was saying, so right at the top of the capital structure. So we'll get repaid first in the case of any issues. It fits in with our thematic sourcing as a firm, software as an industry that we're very keen on. And yeah, being a UK headquartered business, it's a jurisdiction we're very comfortable with from a legal perspective as well.
I'm very conscious of time, so I will be very quick. And by the way, I don't know if you managed to read this because I can barely read it myself. So, but it's the last thing to talk about is our ESG approach. And I touched on it in relation to the sustainably linked loans or the ESG loans, but just understand we also embed it in our investment decision-making process, where we rate and provide a score based on ESG for every one of our investments. And we choose and decide not to do certain investments based on these scores. And over time, we report also our average scores in terms of ESG. It's something we try and do towards the effort to be better and be a positive factor in ESG.
Yeah, I mean, we've been a signatory to the UNPRI, the United Nations Principle for Responsible Investment, since 2008. So one of the sort of forerunners in the private markets there, and we've had an A+ rating every year since 2016. And we're the first private markets firm to be included in the Dow Jones Sustainability Index, which is something we're very proud of.
So thank you very much for a very comprehensive, and you make it sound simple. I'm sure it isn't. So does anybody have any comments or questions? Please.
Thank you, Jim. Just if you're concentrating on senior debt, why do you need a 20% leeway for subordinate debt?
Well, we have some flexibility to do that, and we do see sometimes relative value or attractive opportunities in junior debt. And that can be over time where you are in fact taking some junior debt positions, but we think that the junior debt offers interesting downside protection. However, in our portfolios, we'll always ensure that the portfolios will be at least 2/3 senior debt, if not a lot more. So relative value sometimes will allow ourselves some flexibility, but we focus on senior debt.
Okay, so if there are no other questions, Mr. Bill.
I welcome that reference to sustainability and environmental concerns, because that lines up with the question that I'll be putting later on. If we could have more information on that as we move forward, I think it would be appreciated.
Yeah.
Thank you, Jim.
Yeah, that's fine. Adam.
Yes, on that, you referred to a currency I hadn't heard of, a BIP. I'd kind of welcome some understanding of what that means across across the board, really.
Excellent. Sorry, that's my you get used to my own acronyms after a while. So 100 bips, and my wife, by the way, does get annoyed with this as well. So 100 bips is 1%. So if we are charging 5%, which is for a loan, that's 500 bips. And so when we charge, or an ESG loan is a 5 bips increase or decrease, you're increasing or decreasing the margin from 4.95 to 5, or from 5 to 5.05%. Not a lot is maybe the feedback from that in terms of your the linkage. The reason for that, because that's well, why don't you charge more? Well, it's our job to deliver you, number one, a return. So we've promised you 4 to 6%. We really want to deliver the 4 to 6% and don't want to compromise that. But we want to put in an incentive to the company to adjust that. I would comment that a 5 bips or 0.05 doesn't sound like a lot, but when you're lending 100 million or 200 million, that can sometimes relate into £100,000. Somebody on the board will be responsible for £100,000. It does focus the mind a little bit.
Thanks very much. Mr. King.
Yeah, thanks, Chairman. Thanks for the presentation. I won't begin to say I understand all of that, but there's two things that stand out. One is risk. Obviously, you're taking risks. Obviously, it's all calculated, and you mentioned it you did touch on that. But what's the trade-off between risk and the monies that you're investing? You obviously senior debt. Obviously, you're looking for companies that aren't going to go bust. Yeah. Very quickly, and there's a saying, isn't there? If it sounds too good to be true, it probably is. And you mentioned that the rates of return are the best you've seen in a decade. So are there rates of return too good to be true, or is this, in your world, is this kind of real stuff? Because in my world, probably a lot of people here, those sorts of returns are it's a bit like fantasy football, if I can put it like that. Yeah. So, I'm trying to understand how real those things are, or are they kind of
Yeah,
Do you know what I'm saying?
maybe I'll answer the
Thank
first
you,
part of
Ken.
that, because I made that comment about the best returns in a decade. I think if you look the components of the returns are the margin. The margins have not changed dramatically. They haven't gone from 5% or 500 bips to 1,000. It's gone up, 50 or 75. It's quite measured because there's only a certain amount of interest that companies can pay. So really, it's driven by the interest rate environment, and that's actually just the pure benefit of this asset class. That as quarterly coupons reset quarterly, we get this uplift and benefit that is purely down to interest rates in the marketplace. So that is really the main driver of the increased returns in the market today, not increased risk.
Maybe, I mean, what can go wrong? That's the question. I think with higher interest rates, companies are having to pay more for their debt, and can they afford it? And if they can't, they will go into default and ultimately not be able to pay their loans back. I think that you look back at the financial crisis of 2008, 2009, which was one example of when things can go bad. The worst loss on loans was between 5 and 8% of principal. So loans had a loss of 5 to 8%, depending on where you are and depending things. So one way of thinking about what is that downside for me here is to say, well, I could lose of my principal between 5 and 8%. It could be more, but that's a hard data point from a previous financial crisis. I think that we do our best to avoid those companies that can't afford their loans or can't afford those, but of course we could get it wrong.
Okay, so thank you very much, Louis, Joshua and Chris. Very comprehensive, and I thought you explained it very clearly. I'm not, as Mr. King said, I'm not sure we completely understand what, but we've certainly got the we've certainly got a good grasp of that. So thank you all. Thank you very much.
Thank you very much.
Thank you very much.
So the next item that we're moving on to is item 7, the summary valuation of the pension fund. So Bulesh is going to present this report. So over to you. Now, within this report, you're going to cover off local investments as well, I believe, Bulesh.
Thank you, Chair. So like most quarters, the purpose of the report is to provide the committee with an update on investment markets, how individual asset classes are performing, focusing on private debt and the valuation of the investments as at the 31st of December 22, which is also included in Appendix A. And in addition, this time, we've got information on the Levelling Up government white paper, which we'll touch on as well. Point 2. We've got our long-standing review of short to long-term asset class performance. 2 asset classes now show double-digit returns over a 20-year time frame. That's high yield and gold. Properties dropped out earlier in 2022 and is just below 10% now over a 20-year period. We've got a quick update on portfolio changes in the quarter just ended, and that's covered off in points 3 to 6. It was a busy end to 2022, as many commitments made in 2021 and 2022 were called in the final quarter of 2022. As a result, there were several planned and orderly divestments made from overweight positions to provide the funds to satisfy these calls, which varied by manager and covered infrastructure and private debt in the main. A to C there cover off the 4 divestments. They totaled about 147 million. Point 4 talks about two rebalancing investments which were made in line with the fund's strategic asset allocation. The fund added about £67 million to index-linked bonds in December and £34 million to investment-grade corporate bonds. Both had fallen in value during 2022 and hence the rebalancing. A quick update on cash that the fund holds. Point 6, at quarter end, that's the end of December, cash held by the fund totaled 96 million, plus an additional 20 million cash held as collateral with Aegon for the currency hedge. We'll attempt to keep that as low as possible through 2023 as calls from previous commitments are made. Moving on to fund performance, that's point 14. We've got a little table there summarising the whole fund performance versus benchmark. We've got quarter, 1 year, 3 year and 5 year numbers there. Looking at slightly longer term numbers, and in particular 1 year there because it covers the whole of 2022. The fund versus its benchmark was plus 1.7%. It's worth noting that 2022 was difficult, and the minus 3.5% it endured for 2022 can be seen as a positive for the year. A year which included many negatives, including a sustained equity sell-off, a deteriorating bond market, falling global GDP, alongside rapid global central bank interest increases, all of which provided headwinds. When 18 to 20 covers off approvals regarding the strategic asset allocation from the January committee. Table there neatly summarises the plans for 2023. In effect, the summary of all of those changes you'll see there from the last column is an increase in the allocation to the income asset group of about 5%, whilst equally reducing the allocation to the growth asset group. A schedule of work has been agreed with Hymans to facilitate the changes in a similar way to 2022. Proposals will be considered with officers in advance of presenting these to the investment subcommittees in 2023. The following will be reviewed by Hymans. So we've got a listed equity asset group review, a targeted return review and a protection assets review, all of which are scheduled for the next two subcommittees. I'll read. It's a good point to break there if there's any questions before we move on to the levelling up bit.
So any questions from Maurice?
All right, just one quickly on 10.
Yes.
How much notice do you have? I imagine that you know quite well in advance when you're going to need to pay out more money. Does it ever come as a surprise?
Not really. We tend to get different levels of notice from different managers. Some are about a week, some are about 2 weeks. But we've got enough liquidity in the fund to be able to get the money if we get a week's notice.
Okay, so if there's no other questions, Mr. King.
Yeah, can you just explain paragraph 10 in sort of plain terms, because I'm not a technical person. It says many of the commitments in terms of, so you're talking about underlying committee, the investment committee's made commitments to investment, and then you're saying commitments have been made to illiquid investments. What does that mean?
So illiquid investments are those ones that we can't easily sell out of. So we have a portion of our fund which is invested in liquid investments that can be easily sold, and illiquid investments that we can't easily sell. Things like private debt, for example, are illiquid. So there is no market to sell those out into, whereas we hold a huge portion of passive equities which we can get within a week. So if we need the cash, we can sell it.
You can sell them on the stock market.
Yeah, exactly.
Sort of thing. Yeah. Okay, that's what you mean. Right. Okay, thank you.
Okay, so
Move on.
if there are no other questions, over to you then again.
We've got a section here on levelling up, and I'll read 21 because it's slightly different to the papers you've got. So it's been a year since the government published its policy paper, Levelling Up the United Kingdom. The Levelling Up and Regeneration Bill, which takes the white paper forward, requires the Secretary of State to prepare a statement of levelling up missions to reduce geographical disparities in the United Kingdom and to report on these annually. The paper provides detail on 12 new missions across 4 broad areas. That's A, B, C, and D, which hasn't changed. And 22, I'll read that again. Of note to funds such as the LGPS, the paper suggests unlocking institutional investment in infrastructure by asking local government pension schemes to publish plans for increasing local investment amongst other initiatives. White paper states there is huge potential for institutional investment to support levelling up across infrastructure, housing, regeneration, and SME finance. Institutional investors currently hold UK pension assets of over 3.5 trillion. Within that, the LGPS scheme has total investments of over 330 billion, making it the largest pension scheme in the UK. only a tiny fraction of these funds are currently allocated to local projects. If all LGPS funds were to allocate 5% to local investing, this would unlock 16 billion in new investment. Although the term local investing is not defined in the paper, it was subsequently clarified by England and Wales LGPS's Scheme Advisory Board that in this context, local refers to the UK rather than local to a particular fund, and there will be no mandation beyond the requirement to have a plan. So investments anywhere in the UK could be included in a levelling up plan. The fund, our fund, does invest in funds that do have investments in the United Kingdom. In particular, the LGPS Central Infrastructure Fund has a forecast 25% allocation to UK investments. Considering the UK makes up around 10% of the global economy's infrastructure deals over the past decade, this kind of overweights the UK, which was a stipulation by partner funds when the fund was designed with LGPS Central. The fund has infrastructure holdings with 7 infrastructure managers. We've estimated the current commitments would indicate the fund will have circa £100 million or 14% of all the fund's infrastructure invested in the UK by the middle of 2024. Moving on to point 26, in addition to infrastructure holdings, the fund also holds significant UK property assets. As at the end of 2022, the fund held approximately £397 million in UK property assets from its total property holdings of 418. Again, this allocation is higher than the United Kingdom's benchmark share of global property. Got a fairly long section, 27, A to L, talks about the fund's preference for global rather than local, and I'll highlight a few. B, investment pooling means the fund should engage first with LGPS Central in order to invest, thereby benefiting from lower fees, improved manager oversight and shared governance costs, which should provide better value for money and risk-adjusted investment returns. Of note, at present, there's not been enough partner fund interest for LGPS Central to create a UK-only infrastructure fund. You'll note we do have an infrastructure fund which has a mandate to invest 25% in the UK with LGPS Central. Point C, were the fund to find a manager outside of LGPS Central that invested within a geography, for example, the Midlands, there is no guarantee that funds would be invested wholly in Leicester, Leicestershire and Rutland. In all likelihood, investments would spread or leak outside of those areas into surrounding counties. Point E, investing locally may mean settling for opportunities that offer lower returns than those available from managers who specialise in a wider geography. This could mean decisions are made that are not in the best interests of the participating employers. And just a couple more. I talks about Hyman's having, during the July 2022 infrastructure review, stating their preference to favour global developed market strategies rather than regional strategies. They stated, by taking a regional approach, investors risk investing in markets that do not offer the best investment opportunities and risk suffering disappointing returns. And finally, the last point, there are no restrictions on the managers investing in Leicester, Leicestershire and Rutland if they find the right opportunities. The fund's approach is to allow managers investment decision flexibility in order to find better opportunities. I think I'll break there. If there are any questions, we can take them now before we move to the private debt review.
Are there any questions? Mr. King. Yeah, thank you, Chairman, and thanks, Kesh, for your remarks so far. Obviously, I did make a comment at the last meeting about this and make a suggestion that, based on what you've read out, which obviously isn't paragraph 21 in the report, but the paragraph 21, revised paragraph you've read out, that indeed was my understanding that the Secretary of State had suggested that up to 5% of LGPS local pension funds should be made available for local investment. And Chairman, I do understand there are some challenges with this, but I do think a proper paper needs to be brought forward to this committee for us to evaluate and consider, in the same way that a paper on climate change and divesting from fossil fuels and all that stuff has been brought forward to this committee. We've gone through a lot of work, or officers have as well, to satisfy, and at times that's not necessarily, you know, there are challenges with that as well, because you could argue that actually getting returns from fossil fuel or companies in fossil fuels are actually better than some of the green energy returns, but it all comes back to that ESG thing, and also it is complicated. So I don't think, so I think some of the points you've made, I understand those, but I think we need a proper paper that it goes through the options of what we could or couldn't do. And I do understand what you're saying. You couldn't necessarily guarantee, and no, I'm not suggesting that for one moment, but I do think we need to understand what we can and can't do, so we can then explain to the members of the pension fund why we're not doing it, if that's what we decide not to do, and why we are doing it if we do decide to do it. But at the moment, I don't think that's enough there to really do that. That's my view anyway, Chair. Thank you.
Bullish, what would your comment on that be?
Well, we can follow up accordingly based on the points we've raised within this paper and make it a more comprehensive paper, I suppose. Let's discuss internally, see what would be the right thing to do, and then come back to you, Councillor.
Thank you.
Chris?
Must be. I was going to say something. We can pull all that together in a bit more of a comprehensive paper. That's not a problem at all. I'll just make a couple of comments. I won't be here for the next one, clearly, so I'll have a go.
So you've got free reign, haven't you, Chris?
So, I do remember the debates on this over the years. We have had quite a few debates on it. I think probably Nick and Melissa will remember some of the debates we've had. Also, just mention two things. One is politics and one is practicalities. Yeah. In terms of politics, a lot of the infrastructure potentially you could be investing in is generally stuff that could be difficult politically. So, you know, I know Leicester, let's talk about Leicestershire County area, high growth area. You know, there's going to be need for a lot of infrastructure. There could be a need for, I don't know, a new sewage and water works. It could be, we know there's kind of rail freight interchanges and warehouses and all kinds of things. But clearly this committee has got a fiduciary duty around pensions. That's clearly what you need to do. So you could end up with some quite difficult positions where, you know, we as officers are bringing things back that we think are good investments, but are clearly going to be very difficult for some people around this table in terms of making decisions on. So just make that point in terms of the politics. But in terms of the practicalities, we're not geared up to assess business cases. We're not geared up to do that, to make investment decisions. That's why we have fund managers doing it. And clearly we can pass through different business cases to some of our fund managers to consider. We can do that, and that is one route of doing it. And if you narrow it down to the geography of Leicester and Leicestershire and Rutland, that's a very small geography. So there's real practicalities around that, and you might not get anything, as I say, as Buddha says, you might not get any suggestions actually coming forward in terms of that are practical. And if we were to try and gear up to assess those kinds of projects, we'd have to have more staff, and then some of those projects, as well as just having the kind of the build out costs, you have the operating costs of things like solar farms or wind turbines. Again, it's not just the building of them, there's the operation of them as well. So again, you'd either have to outsource that or have an in-house capability to do it in some way. So there's some real practical issues around it, as well as the politics. So I mean, I'm kind of with you. I think maybe we should do a much more comprehensive paper to point out some of those issues, but it's not straightforward, I suppose, is the point I'm trying to make.
Thank you very much, Chris. Just hold on a minute. Right, Mr. King.
Can I just come back? And I welcome that, Chris, and you know, obviously appreciate that. These are challenging issues. The challenging issues for the politicians that sat around this table as well, because we're, you know, outside of this room, outside of this committee, we have the government saying to us, well, what's going on about your pension fund? You know, and there's a lot of rhetoric and whatever you want to call it of, well, what are we doing about it? So obviously then we're under pressure in a different forum to say, well, why aren't we doing something about it? And I'm sure you understand that because you've been around this game a long time, as does everyone else. So I think that's the challenge for us, is how do we deal with the government rhetoric and statements which says, go and do this, and with the actual technical reality, as you said, practicalities on the ground. And it may be that when we evaluate the practicalities on the ground, we need to go back to government and say, That's very interesting, but these are the problems, and actually you can't do it because of ding, 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 ding. So you need to either sort out these practicalities for us or stop saying it, or one, but without that, appraisal, I've got, because I'm not a technical expert. I'm a politician. I'm not a technical expert, like the people on your team. So that's what we need, because we either need to go back and say it can't be done, but all the, I'm sure very good reasons, or yes, it could be done, but you would need to sort out X, Y, Z first. Thank you.
Okay, thanks, Mr. King. Adam.
Thank you, Chair. I think what we're being asked to do is to make available a percentage, and that doesn't mean to invest a percentage, that means to make available. So I'm just wondering whether there is, with some more work, an opportunity to look what making available might look like, and that may be, that may be around being able to discount a local investment before you move on to looking further afield. It's not disconnected from the net zero piece, actually, because you have more control over your emissions if you're investing locally. So I think it's how we make available that, not how we invest that, is the question that we need to ask. But I really welcome the fact that officers agreed to bring back a more detailed paper.
Thank you, Chairman. These last few paragraphs raise a number of fascinating issues for us all. If we follow the government pattern of where to invest through their Levelling Up programme, we wouldn't be investing very much in Leicestershire at all, would we? Other than Twycross Zoo, I believe. Melton's Cattle Market, which I do agree.
Railway station.
And Leicester Railway Station, which I do agree with, very much so. Because the problem is the government regards the Midlands as an investment opportunity, if you like, not as a whole, but as Birmingham. So the Birmingham area gets all the investment, and the East Midlands, and Leicestershire in particular, gets, trying to choose my words carefully, because this is a public domain, gets very little, apart from the cattle market, Twycross Zoo, and our wonderful station at Leicester. There should have been two wonderful stations at Leicester, but we're left with one now, so there we are. So there we are. So we have got to try to, I mean, it's not for this committee, because this committee has to make as much money as it can for its members, but overall, there has to be the argument put at every possible opportunity, I think, that investment should be evened out across the Midlands, so that the East Midlands in general, Leicestershire in particular, gets a far bigger share.
Thank you, Mr. Bill. Lauren.
Yes, I wondered if I could just come in just thinking about the timing of this, because the bill that's been referred to is before Parliament at the moment. The last time I heard, it was expected that it would be enacted later this year, around May time, normally is when these things come into force. At that time, you'd also expect that the government will issue the statutory guidance to accompany it, which might assist the committee in looking at how that duty might be or power might be implemented. So the timing of it might work well for the committee in terms of waiting for that, so that there's a sort of more informed view.
Yeah, I think that's very helpful. Thank you, Lauren. We can do that. Mr. Clark.
Sorry, just not on that point, but just thinking through kind of logistics. I think the many local authorities, include our own, have our own kind of ethical procurement guides, etc. So a lot of work around what Bullish was saying about investment may be taking place way beyond where you think you're investing. The way we work and the way we kind of monitor procurement on our own projects is to check that at source, and I think that other entities do that, as local authorities included.
Thanks very much. Okay, so there are no other comments. So the committee are asked to note the valuation of the fund. Is that agreed? All agreed? Yeah. Okay, so we move on to item number 8. We have pension fund valuation, consultation results and fine assumptions and results. Ian Howe, our pensions manager, is here. The pension fund valuation is at pages 29 to 142. And over to you, Ian, to present.
Thank you, Chair. Morning, everybody. This report is the kind of the conclusion, really, of the valuation work that's been going on for about 18 months. And this is the valuation as at 31st of March 22, and sets the employer rates from April 23 through to March 26. This particular part of the valuation exercise was on the funding strategy statement and the investment strategy statement and the consultation that followed with the employers and others in these areas. Taken both in turn, the funding strategy statement, we had a few questions from employers, but no specific changes required. There were more questions around how it affected individual employers rather than the actual detail in terms of changing any elements. There was only one element of change that's been brought through to the final FSS, which actually is more of a technical point that came from the fund actuary, and that was making it explicit that members affected by the McLeod remedy, their benefits are going to be calculated with the expected regulations rather than the current regulations, because they're currently outstanding. So it's only a technical point, but in terms of the calculation methodology, it's exactly as we did it. In terms of the ISS, the investment strategy statement, there were no comments or changes received on those points. There was also the net zero climate strategy, but I won't dwell because I'm aware that there's a further report on that particular point. The assumptions that are mentioned in my report are those that we used in the calculation. They haven't changed from the information that was provided to the committee at the last meeting. So they are the final versions that we used in the final calculation of the valuation. The good news, as Chair has already touched on earlier on, is that the fund overall valuation as at the 31st of March was 105% funded, which is really good news. It means we're actually fully funded for the first time in a long time, which is a really good position. The position as at the last valuation, which was March 19, we were 89% funded. So it gives you an indication of how that's really improved in that 3-year period. The table on page 34 shows the various stages that we've worked through in terms of the valuation work. And this is kind of now bringing this to a conclusion in order for us to write to the employers with their final employer rates. All the employers have had their indicative rates, but after this committee, we will be able to confirm the final rates to all the employers, which are in fact those that we've already provided on the indicative rates. That's all I was preparing to say, but obviously happy to take any questions, Chair.
Thank you very much, Ian. Has anybody got any? This is a pretty factual report. Has anybody got any questions or queries? No? Okay. So we're asked, it's recommended that the local pension committee approves the revised funding strategy statement, the revised investment strategy statement, the final assumptions used in the 2022 fund valuation, and the 105 indicative whole fund valuation result. Is that agreed? Agreed. That's unanimous. Thank you. So we're now coming on to item number 9, the outcome of the consultation on the net zero climate strategy and responsible investing update. We also have some questions from Mr. Bill, which he's raised under standing orders, which have been circulated to members. I will ask Mr. Bill to ask his questions following the presentation of the report. So, if our responsible investment analyst will now present this report.
Thanks. As committee will be aware, we recently went out for consultation on the draft net zero climate strategy. The draft strategy sets out how the fund will manage the risk and opportunities arising from climate change, giving the recognition of it as a material risk to the fund, which the fund must manage in line with its fiduciary duty. This is all to ensure pensions can be sustainably paid to more than 100,000 beneficiaries in the coming decades. The fund's ambition, as set out in the strategy, is in line with the goals of the Paris Agreement to drive down real-world carbon emissions while addressing the risk of climate change to the fund, whilst maintaining investment returns. This builds on the positive progress the fund's already made since the first measurement of the fund's carbon metrics in December 2019, where we've seen the 26% reduction in carbon intensity. Just as a reminder, the key sections of the strategy set out the background of the fund, why considering climate risk is important, as well as the importance of the fund's fiduciary duty. We also have a section on how the fund will embed climate risk and opportunities in its day-to-day activities, taking into account both physical and transition risks and opportunities. We have the targets and measures for the fund, which we previously engaged on. We set out the key target of net zero by 2050 with an ambition for sooner, with the other interim and secondary measures. We also have a section on decision making, so how the fund can integrate the targets and measures as part of the strategic asset allocation and any investment decisions. And then, of course, the section on stewardship, engagement and divestment, so how we engage with our managers and with companies to drive the transition to a low carbon economy. And that also sets out how we will escalate our actions where we continue to hold concern. The consultation ran from November to the 5th of February, and we received 748 responses. A lot of themes and comments raised largely reflected what we previously saw as part of the early engagement on the targets, with the majority supporting the approach of the strategy, as well as, of course, the polarizations of those who either didn't feel climate change was a concern for the fund or that the fund needed to be more ambitious. A summary is included within Appendix C, and that also includes the documents submitted by Climate Action Leicester and Leicestershire, which also include where they receive support from local organisations and individuals on their response. So if we just look at kind of the high-level results of the consultation, we saw 65% of respondents supported the strategy and 20% did not. Comments received through the consultation have resulted in a number of changes to the draft strategy, and they are summarised in the table below paragraph 43 within your report. I'll just highlight some kind of key changes because I'm sure members will have questions. So I think one of the most important additions is the implementation plan and manager questionnaire, which is appended at Appendix B. So this was referenced, if members remember, within the RI plan that you approved in January, which set out how we intend to kind of get a baseline of what our managers are currently doing. So within the questionnaire, we include what initiatives they might be part of. So partners just mentioned they were part of the UN PRI, I think, and then also if they've set their own net zero targets, and then whether those targets actually kind of apply to the fund's investments with them. We also want to see how they're measuring climate risk and the data they have currently available, and also if they have their own kind of in-house exemptions or divestment thresholds, which I know was of interest to members back in November. So the answers we receive from these managers should help us address the agenda moving forward to see if their strategies are in line with the net zero climate strategy. And these are points that have been strengthened throughout the strategy in terms of the stewardship, engagement and divestment section, where it considered where we set out where escalation would be required, where we see managers lag against peers. We've also kind of broadened the section in terms of how we're measuring companies. So previously within the strategy, we had listed Climate Action 100 Plus's kind of key benchmark figures. We've broadened this to kind of set out, it's clear that we want to follow best practice. So within the previous climate risk reports members have seen, we didn't just monitor against Climate Action 100 Plus indicators, but also the Transition Pathway Initiative carbon indicators. And we're also awaiting the outcome of Climate Action 100 Plus's own consultation on proposals to enhance that benchmark. which we'll see what comes out of that. So there's a number of actions that will almost immediately progress subject to approval of the strategy. So that includes working with Hyman Robertson to take into account key considerations from the strategy and any new investment proposals. So Bilesh mentioned previously in the summary valuation paper, we're expecting this review on listed equity. So that will be quite taking into account the net zero climate strategy will be very beneficial for that, especially given it's such a big part of the fund. We'll also review relevant fund documents, including the risk register, as well as work with Eligible Central to continue to develop how we can report on climate risk in line with the strategy. And also set out our own expectations that they need to set their own operational net zero targets. We'll measure progress on an annual basis through our climate risk reports, as well as review the strategy at least every 3 years. And that's all I say on the strategy. I will briefly go on to just the rest of the report on the general responsible investment bit, so I don't forget. We talk about the report on voting and stewardship progress. We've kind of highlighted a few key engagements over the quarter. So there's which may be of interest to members such as Renault and Barclays. I've also highlighted the recent press release from LGPS Central regarding the derivative action from Client Earth against Shell. I know they mentioned that in January to the committee and they were kind of weighing it up, whether they would take part. Ultimately, they've not formally supported the action, but they've supported it in another way, which their press release is within the report. But that's all I was going to say, other than just to remind members that Central have their Responsible Investor Day on 9th of March. So you should have all received invitations for that at this point.
Thank you very much, Kat. Now, before we move on to taking any comments or queries, I'm going to ask Mr. Bill to ask his questions, so which will receive an understanding order.
Thank you, Chairman. I believe my question has been circulated. I don't know. Can you just remind me what page it's on? If it is in.
It's done by email.
Not in the pack. All right. Okay, thank you. Yes. Well, first of all, I do very much welcome the comprehensive report we just heard from Kat. I believe that is that's very encouraging in itself. What the situation that has been outlined in the question is the fact that at Hinckley, a motion was passed asking various points on this matter. I declared an interest there because I'm a member of this committee, therefore I didn't take part in the motion. But it would be useful if we could have a response. The problem that we have, of course, is that we all recognise the need for us to try to play our part in combating climate change. And although this is only a small part, I think it's a part that falls upon. We have a responsibility to play our part in that, and of course we have to balance that against the fiduciary responsibility that we have as members. It's a difficult balancing act, but I would appreciate a response to the question.
Okay, so if you would just read the questions out, we'll.
You want me to read the whole thing out?
You can read the question out so everybody knows.
As officers will be aware, Hinckley and Bosworth Borough Council passed a motion on the 22nd of February, which included several requests to the pension fund regarding investments in fossil fuels. Given Leicestershire County Council, my own council, Hinckley and Bosworth, and others have declared their own climate emergencies, I have several questions regarding the report before us today. I should say that I recognise the fiduciary responsibility placed on us as trustees to safeguard the financial interests of more than 200 employers and 100,000 scheme members. How can the fund, the first question is, how can the fund support employers' own commitments to environmentally and socially responsible stewardship, given the impact of the fund's investment in carbon-intensive sectors such as fossil fuels? Second question, how can employers be sure that we, as the Pension Fund Committee, are considering climate risk as part of our fiduciary duty if we are still investing in fossil fuels by 2030? Thirdly, how is the fund seeking assurance that its investment managers are appropriately considering material concerns around climate risk? Now, I'm happy for the answers to these questions to be provided when the report is presented. I also understand that officers will need to respond directly to Hinckley and Bosworth Borough Council, and I would ask that this committee is also provided with a copy of that response. Thank you, Chairman.
Thank you. Kath.
Chair, I'll take them in turn, and of course we can circulate any response that we provide to Hinckley and Bosworth. I think we might be waiting on formal notification that the notice of motion actually passed. But in terms of your first question, we know that some of our local councils have their own committees, their own commitments, but that's not necessarily all of them. The fund, of course, supports our employers that have set commitments. For example, within the strategy itself, we recognise the county council has set its own the challenging target to help the county reach net zero by 2045. And like the decisions that are taken by our employers, the fund cannot make these decisions for reasons other than the primary purpose to ensure pension benefits can be paid. Though we are pleased in many cases that duty also coincides with the investments that positively contribute to the transition to net zero. In my report, there's an update on LGPS Central's Core Plus Infrastructure Fund, and that recently invested in UK-based battery storage and other UK-based investments supportive of the energy transition alongside other key investments. In terms of the impact of the fund's investments, such as fossil fuels, the fund has to consider that risk as a whole across its investment portfolio. So if we consider that with through divestment of fossil fuel companies alone, all that would do would remove any influence the fund has and would do little to reduce real world emissions. For example, if another long-term investor, if another less long-term or responsible investor purchase those holdings. So the net zero climate strategy instead focuses on real-world emissions reductions throughout our portfolio, which is why we have those, those 5 biggest contributors to our financed emissions. They're not only fossil fuel companies, but cement and companies related to semiconductors. So the fund is managing it in a strategic way, in line with what is projected to be the best support to the fund's investment returns as set out in the most recent climate scenario analysis. And through that, we can ensure that contributions remain affordable for our employers. If I go on to the second question, so as a reminder, how can employers be sure that the Pension Fund Committee are considering climate risk as part of the fiduciary duty if we're still invested by fossil fuels by 2030? So as members will be aware, the committee has followed proper advice, best practice and clear data available to the fund at this point in time. This has included short, medium and long-term consideration of the fund's current asset allocation in multiple climate scenarios and includes assumptions on carbon pricing, among others. This is why the fund has looked to take a strategic approach to managing climate risks and opportunities in a way that will best protect employee contribution rates. The fund recognises risks posed to the fund from fossil fuel companies, and this is why within the strategy it sets out that one of the targets is to reduce its exposure to fossil fuel companies, which we will of course monitor annually. But as I mentioned previously, climate risk exists not only from fossil fuel producers, we have to consider this as a whole in relation to transition and physical risks. If we were to fully remove fossil fuel companies, it's unlikely to result in a desirable outcome in relation to the pace of the transition. It does not protect the fund, given all sectors and regions will be impacted by the associated risks. The fund must do its part to engage responsibly on climate change, and so that involves engagement on both the supply and demand of fossil fuel companies. So if we've asked our managers to divest from companies, this would reduce any influence we had over the company's transition plan, just like any fossil fuel company selling their assets to other operators. The impact to the real world emissions is zero, and that could risk a negative impact on transparency and emissions if the new operator or asset owner, for example, is operating in a less efficient or responsible manner. And this has been seen in some of the some underlying companies where polluting assets are sold to private equity and local operators. So subject to approval of the strategy, the fund will align its approach to investment decisions, investment manager monitoring, and also build on the approach to engagement with our active managers, where we will ensure they are continuously reacting to market events. Progress on, sorry, that kind of repeats itself, but I'll go onto your third question. So how are we seeking assurance from our investment managers? I think that really builds into kind of one of the key changes we made to the strategy, as I kind of referred in the intro, in terms of how we're kind of getting a better understanding and evidence of that managers are making in terms of these key considerations about climate risk. And this is something that's not new to the fund, so appropriate consideration of ESG factors has always played a part in manager selection, and no manager is appointed unless they show evidence that these considerations are an integral part of the investment making decision processes. And of course, we've got the investment manager questionnaire. So that covers the investments, the fund, what targets they've set, if that covers the fund's investments with them, and what data they monitor, as well as their approach to climate change more broadly. And of course, we'll continue to invite managers to quarterly meetings where they can present on factors, including climate risk. Any concerns or factors the fund must take into account which arise, we can consider as part of the annual climate risk report, strategic asset allocation, as well as any decision making taken.
Okay, thank you very much. So we've had the questions in the standing order. Some very comprehensive answers have been returned by officers. We now return to the principal item, which is the outcome of the consultation on the net zero climate strategy and responsible investing update. I can take questions and comments. Mr. Grimley.
Thank you, Chair. The net zero climate strategy has had a lot of time in this committee. We've been looking at it for a while. It's been a long journey on this. We've had lots of debate on it. I think we coming to a good conclusion on this as a working document for future amendment. I mean, there's been a lot of engagement with all stakeholders, employers, pension members, local authorities, which include Charwood, Blaby, Harborough, North West Leicester, Oban, Wigston, Hinckley, and also Leicester. I know they don't all agree on things on going forward and that, but they have had the opportunity to put things forward into the consultation. Yeah, so for what we've done on this, I'm happy to agree that this amended report is approved. It is a working document. I accept that. I accept there will be lots of periodic reviews, but I think the alternative, if we put lots of changes in it, that it has to go back out to consultation again, and we're not going to have a document in place at the moment while it's being re-looked at. So I'm happy to support this.
Thank you very much. Any other comments or questions? Mr. Clark.
Thank you, Chair. The City Council's share of the Leicestershire Fund is around 30%. In the year ending 31st of March 22, employees' contributions were £11.8 million and the local authorities were just under £50 million. It's not insignificant, and which is why, I take this incredibly seriously, because recognise that where I've come from, there's a lot of money coming from the city into this fund, and there are very strong views held within the city. My concerns are manyfold, but I do want to start by saying progress has been made, and I absolutely recognise that, and a lot of hard work has gone into this, and I pay credit to those officers, and I thank them for the time they've given me as we've talked through this this process. The mention of Client Earth always rings bells with me, because I have to consider climate lawyers and environmental lawyers when I make decisions as the Deputy Mayor responsible for environmental issues in the city. We are not immune from legal action from Client Earth as a fund. They look at all of us. They look at central government. They look at Shell. They also look at local government, and they also look at pension funds. And we have to recognise that any decisions we make might be open to litigation from client earth if we're not taking appropriate action within legislation. So that's my first concern. Are we defending ourselves properly against litigation if we're moving forward with what might be considered to be a vague and inconclusive strategy? I think where the strategy is good is that it recognises that responsible investment and divestment are not mutually exclusive, and that is clear and explicit within the document, which is welcomed. But as we've raised concerns throughout, that there are not clear enough trigger points for when explicit action might be taken that is in the best interests of all fund members. And I'm particularly concerned that young fund members may be put at a disadvantage by the lack of climate action. If we don't take action now, it's not older members that are going to suffer, it's those young members when they come to retirement they're going to suffer if we're not taking this as seriously as part of the fiduciary duty as maybe we should. There are very few what I determine as young fund members sat around this table now, for instance, myself included. I'm not a member of the fund at all, and I'm certainly not young. My final concern is related to some email tennis we've been having, Chair, around access to training and information beyond our own advisors. And I do feel like, frankly, we've been blocked from having a broad range of training and information. It was a former president of Harvard said, if you think education is expensive, try ignorance. And, we've had a giggle around not understanding certain things that come before us to this committee, but actually it's very serious. If we don't feel like we've had the information, we don't fully understand the decision that we're taking, the opportunities that we might be missing, are we really in a position to in the best interest of members to take forward a strategy that may not be as rigorous and robust under the eyes of the law or its members? And that's where my concern is. So whilst I really recognise the progress made and the skill and expertise of officers and the conscientiousness that I've been shown and given, I can't support this, Chair. Thank you.
Okay, thanks for your views, Adam. I'm sure when we make a decision, we will bear in mind all those things. But I think I've never known a consultation go out and such effort been put into anything, and the time that has been spent on this is not inconsiderable. And quite honestly, I think the advice we've got and everything else seems to be excellent. I mean, we're not experts. We do rely on advisors. They have taken a broad range of views, but that's my opinion. And we will see what the other members have to say. Mr. Lawrence.
Yeah, thank you, Chair. Yeah, I'd also like to start off by thanking the officers and their advisors for the professional work they've done to write the strategy, consult on it, and take account of scheme members and overall feedback and specific comments, and obviously meet, as has been said, meet with individual members of the committee to discuss these matters. I certainly would like to acknowledge and support the inclusion of an implementation plan, the investment manager questionnaire, which I think is a real boost to the whole structure around this net zero climate strategy, and I think that's really good, and it represents a good strengthening of the approach to stewardship, engagement, and divestment, and that has clearly been a positive result out of the consultation, particularly around the fund's level of ESG engagement with investment managers that it retains, and also improving communications with scheme members about everything around ESG in general, as well as the climate change aspects, which I think, obviously as a scheme member representative, I really support that. I think it will be beneficial going forward. A couple of things one thing I do find I'm disappointed about in the final strategies is there's no additional interim milestone targets have been included between now and 2030. So we're still looking at the first interim target to see how we're getting on in terms of maintaining progress towards Paris Agreement alignment 2050. The first sort of big milestone to 2030. Well, there's major concerns, that in my mind is that we need some more interim targets that we can be assessing more formally before that time. I mean, I recognise that the climate strategy has been said, it will be reviewed if we need to put more specific scrutiny, if I can use that word, around where we've got to. Obviously, that will happen. I recognise that. But nevertheless, I would have liked to see those interim milestone targets. I'm also concerned that the companies that are very proficient at what we generally term as greenwashing may not be found out by the processes that we've got within set out in the strategy, and that really, for me, comes down to kind of the limitations that the strategy places on the climate performance criteria that are employed. I mean, there are a whole range of climate action 100 plus framework criteria. Some of those are more action-based criteria, and I would have liked to have seen more of those recognised and provision for those to be used, because they are the ones that really assess, in my mind, commitment to alignment with the Paris Agreement goals more effectively, and that's where that's the fundamental underlying basis of the strategy is that Paris Agreement goals 2050. I mean, finally, unless officers can offer me any reassurance on this, I really cannot see, in my mind, a clear and timely pathway from what we see now with some of the major fossil fuel polluters, such as BP and Shell, that have been referred to in this meeting already. So what we're seeing now is BP and Shell redoubling their efforts to explore and extract more fossil fuels, and as far as I can tell, failing to invest in renewable energy generation at the same time, or even prioritising that in any way. So I can't see a clear and timely pathway from that situation to the time when the Leicestershire Pension Fund actually sells its remaining shareholdings in these companies. I mean, I think, I've spoken about the previous committee meetings about, it can't be that long before, holding shares in these companies is going to, they're going to become stranded assets. And, in my mind, at least, I just feel like it can't be that. It could be just a matter of a few years before these companies' share prices start to stagnate or even fall. If we're left holding a lot, so it's not, and that's a fiduciary duty issue. It's not a issue around what different feelings we have might around this committee table around the sort of more emotive side of it. That's actually about money and assets for this fund. So kind of regretfully, for these reasons, I feel, while I fully support the fund having a net zero climate strategy, I find I can't support the strategy in this form. Thank you, Chair.
Okay, thanks, Jeff. I'm sure we've all taken a great interest in this. Mr. Bill.
Yes, thank you, Chair. I'm going to first of all thank Kat for her comprehensive response, and I'd very much like to see that come out as in our minutes, if I may. I think I very much agree with Adam Clark on this. I think we're all of the same mind. There's no need to go over all the arguments again. But we don't need to be experts to see what's happening to the Antarctic, for example. We're all playing our part, not just here, but all the other investment managers in the country. This is a challenge to us all. We've just got to keep monitoring this and hope that we can come to a solution. But I think this has been a very useful report. and the original report is fascinating. And I would hope there would be a public debate on this. I think to some extent we've all been blown off course by all the other challenges we face, COVID, the economic situation, and the war in Ukraine. But this one is one that's not going to go away, and we've all got to play our part in trying to combat it. Thank you, Chairman.
Thank you, David. Thanks very much. Now, have we got any other? Right. Hang on. I'll take Mr. King next.
Yeah, thank you, Chair. So I am going to support this. I don't have a problem doing that. I think this is a very pragmatic and sensible way forward. Looking at the response, there's 40,000. This scheme is set up for the benefit of the members. There are 40,000 scheme members. It's not for the benefit of our. I mean, I'm here representing the county council. It's not here for the benefit of the county council. It's here for the benefit of our employees who work for us, the constituent members, and that's something we need to try and recall. Now, of the 40,000 people who've been written to, approximately, only 1.87% have responded, which to my mind suggests that most of them, because when you don't get a very high response, if a lot of them were very unhappy and dissatisfied with the approach, I would have expected to get a much higher response from scheme members to say, look, we're not happy with this either way. And we haven't. We've got a kind of very low level of response, probably what you'd expect to get just from any sort of direct mail shot. And I'm kind of, as I say, I'm not uncomfortable with that. I think there has been quite a lot of consultation, not just with this version, but also with the previous draft that happened as well. So I'm quite comfortable with this. There are changes that have been made, and so therefore with the set of recommendations that are on the page 161, I'm quite willing to support those because I'm representing the county council, and also because I'm here to oversee the fund for the benefit of the 40,000 members, not the, and we talked about this earlier about local investment, we touched on, it's a similar sort of issue. So we've got a fiduciary duty, we also have a responsibility to ensure that the fund can get the best returns for the members of the fund. Sure, that has an impact on the contributing authorities as employers, and that's where it then, I suppose, gets a bit political, but I'm not going to get into that now. This is, for me, I'm quite happy with this. Thank you, Chairman.
Anybody else got it? Nick.
Thank you, Chair. Talking about fiduciary duty. My definition of fiduciary duty is that the members of the pension fund get the pensions that they were promised. That is how I define it myself. We have members of the pension fund between the ages probably of 18 and 105. And for the 105-year-olds, this doesn't really probably matter. But for the 18-year-olds, it's absolutely fundamental to their fiduciary duty to actually get their pension when they're 90, relating to climate change. So that's how I define the fiduciary duty. And I think we should be aware of that, that those promises are paid. So then coming back in terms of, what can we do that actually works to help within that? We're talking about you were talking about 26%, was it, that reduction in emission carbon intensity? Well, could we have, what's it going to be next year, and what's it going to be the year after? Instead of waiting till 2030, is that something that we could do in terms of that? And then the other point we're talking about the oil companies. I've seen that with we're probably going to need the oil companies to do something to get this to work, but at the moment they're rowing back. In terms of BP, they're talking about increasing their fossil fuel investments, not going back, because what they were talking about 2 years ago was actually a step in the right direction, was positive. Now they're not. What are we doing about that? So that's my two pence.
Thank you very much. No, Adam.
Yeah, I just want to come back to what Mr. King was saying around scheme members and acting on behalf of those scheme members. I did preface my comments by talking about the £11.9 million that Leicester City scheme members paid into the financial year ending 31st of March 22, and it is those scheme members, with a particular eye on those younger scheme members that Nick referred to, that I'm thinking of when I make my comments.
Thanks very much, Adam. So, Lauren.
So I just want to contribute, as has been reference made to the threat of litigation. As the committee will appreciate, you can never eliminate the threat of legal action or claims being made against any public body for failing to act rationally or reasonably, or in this case, for failing to apply the fiduciary duty. I'd just like to remind the committee that we had a paper on the fiduciary duty at the meeting last time, and that reflected the current state of the law. So that is about the predominant objectives of the fund. There's been no change on that. It's not a sort of pick and mix here. You have to apply the law as it is currently in force, so by case law and statutory guidance. That may change over time, but the report as drafted reflects the current position. Thank you, Chair.
I'll say what I've said previously.
Just hold on, please, Mr. Clark. Just hold on. Yeah, thanks very much for that, Lauren. So this reflects the law as it is now. Adam.
And the law is interpreted, and Client Earth are very, very successful at taking government and other institutions to court where those institutions have felt that they're applying the law correctly, and Client Earth have found that they haven't been on multiple occasions. And so those reassurances, whilst they go some way, they don't fly in the face of the evidence of Client Earth's successes.
Thank you very much, Adam. Any other comments? Kat, what you doing?
Just come back briefly on some of the points that kind of, especially that Jeff and Nick have made in terms of, those interim targets and measurements. We are going to monitor this progress every year. So we'll see whether the fund is on the right trajectory. Obviously, since 2019, we know we've kind of all of our trajectories in terms of exposure to fossil fuels, exposure to climate solutions, they've all been going in the right way that complements this strategy. So I don't think we would sit on that and see, this is going the completely wrong way. I think we'd look into that and understand why. We need to hope that the underlying companies are going to decarbonise, and that will help the fund. And if it's not, there's clearly other things that the fund will need to take into account in future iterations or in considering its targets. There's the point about companies are proficient at greenwashing. I think we recognise that the places like Climate Action 100+, they only have the data that's available publicly. I know some of the improvements Climate Action are looking to make on the benchmark is in terms of having sector-specific points about just transition and really kind of build on what their current benchmark is and how they can better monitor companies. So we'll use that and we'll use whatever best practice is available to Central. I know Central have mentioned previously at this committee a tool called Net Zero Zeal, which is kind of an academic tool which claims to be greenwashing proof. So that's a really positive tool. We just have to see how we can input that into our next climate risk report, and that will be an evolving process, I think, over the next 3 years, definitely.
Thank you very much, Kat. I don't think there's been an expression of everybody's views, and ultimately it's down to us to decide. I think this is a step in the right direction, definitely, but there are varying views. Has anybody got anything else they'd like to say? Anything else? No queries or questions. All right, so the recommendation is that the outcome of the public consultation on the draft net zero climate strategy be noted, that the amended net zero climate strategy be approved, and subject to the approval, the associated implementation plan and manager questionnaire be approved. It is noted that the Director of Corporate Resources may use his existing delegated authority to make minor amendments to the strategy and associated documents in order to ensure the document remains fit for purpose. The update on the Responsible Investment Plan 2023, including update on voting and engagement, be noted, And it is noted that the Director of Corporate Resources, following consultation with the Chair, will respond to Hinckley and Bosworth Borough Council motion calling for the fund to divest from fossil fuel companies by 2030. So we're going to...
Can I second?
Yeah, thank you. Can we have a vote? Can I see all those in favour? Right, and let's... Members have sat down. We'll carry on. Okay, just for the record,
Please, Chair, we're just going back live again.
Okay. Okay, so just for the sake of clarity on the item, the adoption of the outcome of the consultation on net zero climate strategy and responsible investment update, the motion was passed. There were 6 people in favour, 2 against and 1 abstention. We now move on to the pension fund key administration priorities. So that's agenda item 10. Ian, I'm going to ask you to present this report, please.
Thank you, Chair. I'm obviously very well aware that the committee have a vast array of items that they have to consider. And administration probably isn't always top of the priority for obvious reasons. Investments and things that you've just talked about are key areas, but this is just the report in terms of the administration priorities for 23-24. These are included in the pension section's administration business plan, which is actually covered in the next report as an appendix on the budget. I wasn't proposing to go through every item for obviously for time, but I think the one that I really do want to just bring out is dashboards. Just really for an awareness. Some board members, some committee members may already know, but just in terms of an awareness, this is a new government initiative whereby people will be able to view all of their pensions in one single place, and this is known as the dashboard. So all pension administrators are being asked to sign up to the dashboard. It's actually a statutory requirement, but it will be done in a phased approach. And anybody will be able to just log in with one single login, and from there they will then be able to search to find all of their pensions that they may have from other companies. It's expected that people will build up 11 pensions over their life of their career nowadays, and it's to help people track their pensions, identify where their pensions are. A lot of people lose their pensions, and this is a big exercise that's taking place. And we will be one of the many administrators that are working on this. We've actually already started to do some work on this already. The onboarding for LGPS isn't until September 24, which sounds a long way off, but there's actually a huge amount of work to do to get to that point, both technically and in terms of getting the data to a position that works for the actual uploading of the information for when it's pulled through. Again, some slightly technical, but in terms of the way it needs to be formatted, in terms of the way that the information can then be pulled through to dashboards. So this is an area of work that's going to be a significant area of work in pensions. We're working with our system provider Haywoods in terms of the setup, and I'm sure I'll feed back over the coming sort of 18 months on how this is progressing. I wasn't proposing to mention all the other areas, they're all listed in the report, but obviously happy to take any questions, Chair.
Thank you, Ian. Have any members got any questions or queries on this? No? All right, sorry, Clive.
Hi, thanks, Ian. Do you think this could represent a risk to the pension in terms of people who perhaps hadn't claimed their Leicestershire County Council pension and now suddenly finding they will? And would it be possible to put any sort of scope on that or scale?
It's a very good question. At this stage, I don't think I can put a scope on it, but I certainly do think, and nationally this is considered as well, they've done some exercises with other pension providers already. They believe the interest in pensions is going to go up significantly. And yes, it also opens up other questions around, will then people then wish to transfer benefits? People may have lost benefits, they're now re-engaged, because will they then want to transfer them in, pay extra, etc., which is all good because it's going to generate more interest, and that's what it's designed to do. So the specifics in terms of how much, we're not sure, but I think the overall there will be a greater increase in questions, queries, and time spent around this, yeah.
Thank you very much. So it is recommended that the committee notes the key priorities for administration during 23-24. Is that agreed? Yep. Thank you. So we're on to the item 11, which is the pension fund business plan and budget for 2023-24. Declan is going to present on this. For one fearful moment, I thought we went here, Declan. All right, thanks.
Thank you, Chair. Thanks for noticing me. The report covers three areas. Obviously, we've got the administration section that sort of Ian primarily sort of looks after. We've got the investment sort of side of things, which obviously mainly that comes through the committee, and also there's the budget in this report as well. So I wasn't going to go through the administration section particularly, because it really covers a mix of national priorities that the team have to react to, but also the local initiatives just help the service run better. And in truth, Ian's covered off most of the kind of the big points in that sort of previous paper. Just as a reminder to the committee, we don't do huge amounts with the admin section because it's a delegated responsibility to the pension board, but it is useful a couple of times a year. We do try and bring things just to sort of top up your understanding and whether there is any sort of questions you want to bring up. In terms of the investment side of the business plan, again, I wasn't going to go into too much detail because it does build on the sort of different strategies and policies that come to the committee during the year, you know, whether it's the strategic asset allocation you saw in January that now we've got to implement, or the sort of training plan work that we've been doing that's sort of built off those sort of training needs assessment. And, you know,
suppose reinforcing the point that was made in the sort of last or a couple of agenda items ago, you know, the net zero sort of strategy has been finished and it's in place, but actually in some ways it's just the next phase of the hard work, and you'll see that the business plan is kind of, there's an awful lot in there about actually implementing the strategy itself over the course of next year, and it will be a sort of a continual process there. The final point I was going to make on the investment strategy, there's a date in there that may sort of look funny at first. It's about sort of the midpoint review of the valuation, and it's labelled as sort of October of this year, which may seem strange in that we've only just signed off the valuation, but all the assumptions of the evaluation go back to March 2022. So, you know, 18 months through is actually sort of the autumn. So even though sort of Ian's just finished that work, he's having to sort of start to think about cranking up for the next valuation. It's a bit of a Forth Road bridge, unfortunately. So the final bit of the paper is the budget, and it's kind of just talk on that sort of very briefly. It's obviously dominated by investment management costs. You know, it got debated a little bit before what is a basis point, and the fund management industry do kind of convert everything to basis points because it makes things sound really cheap. But when you do actually flush those big numbers through, as you'll see from our own budget, they're massive numbers. So always do be a bit wary of basis points because, like I say, it's partners caught themselves out a bit because fund managers have always tried to talk about things in basis points to make them sound small. Now actually they needed to make people realise how big it can be. They've actually sort of tripping over themselves, but that's irony, I suppose. So the fund management costs are really difficult to forecast. It's not just about the level of assets we've got or the individual kind of charges that we get from those managers. It varies an awful lot on the mix of those assets because different managers have different costs. And also the performance of individual managers in the years, because some of the managers have performance fees and some of them don't. So depending on what's performing well at the moment can really sort of make a difference. I suppose the big assurance I'd give to you is that all of the transitions that we've been making to the central pool have been at a lower cost. So we are gradually sort of reducing that underlying kind of cost base. It's just it can get blurred with everything else that's going on. So there is some assurance there to try and cut through the fog, as it were. Other big cost in there, you'll notice the LGPS central costs have kind of taken a bit of a step up. They are entitled to have a minimum cost at sort of inflation unless it's agreed otherwise, and they have requested that. There was a bit of pushback from Partners Fund around it, but Central are going to, you know, they made that decision. They said they need that cost, and to some extent they could justify it. It was agreed at the sort of the last meeting. Obviously, sort of Central are going to have to sort of live with it when inflation does fall back below, because it's obviously going to be remembered. And the final point I was going to make was around staffing. It's mainly around sort of Ian's team. It is relatively stable. There is some temporary resource in there to deal with things like the cloud. We have forecast that's on an ongoing basis, mainly because there's always another initiative or something coming up that hits the administration section. So it's just a reasonable assumption. But it is one assurance that we do get asked by people like sort of Scheme Advice Board and Pension Regulator is that the pension administration is run separately from the county council. So if the county council's got a spending pressure, that doesn't spill over to the administration section. They are resourced to kind of provide the services that the pensioners need. That's all I was going to say, Chair. Happy to take comments or questions.
Thank you very much, Declan, for a comprehensive report on that. Has anybody got any questions or queries? I don't see any. Oh, Clive.
Thanks, Declan. It's just paragraph 14 about the 43% performance of one particular fund manager in there. I mean, it was just a comment, really. There's interest. I mean, I can understand that if you invested in something like Tesla or Google or Apple in the first year, I mean, then it goes up. And these things can be very cyclical because clearly Tesla and Apple and Google have all substantially dropped off in those subsequent years. So these very highly cyclical, I mean, I don't know if it is possible, it probably isn't actually, but it does seem like they only seem to get the upside. And when it sort of goes the other way, there's no reaction in terms of their performance management. I mean, it's just, I mean, I'm sure we can't do anything about it. It's just a note. I mean, I can understand that.
And I suppose just on that one, that one wasn't an equity investment. Interestingly, it's a manager who kind of do sort of the trade more in derivatives and those short stocks, short commodities, long commodities, things like that. So they'll bet on prices going up and down. So they are kind of, like you say, sort of very cyclical. They do have the highs and the lows, but that manager in particular does have a kind of the performance fees on the kind of the upside, like you say. And it's not something we necessarily like, but it's often a feature of the industry that the industry's lined up in one way, and it's a choice if you're either in that asset class or you aren't. But like I say, if we had a choice, we probably wouldn't tilt towards performance fees, but we don't always have a choice, to be honest.
Thanks for the question, Clive.
Other questions or queries? So the committee has been asked to approve the business plan and pension fund budget for 23-24. The committee have been asked to approve that the Director of Corporate Resources, following consultation with the Chair of the Local Pension Committee, be authorised to make minor amendments to the pension funds budget following the approval of the LGPS Central's budget. Is that agreed? Right, that's unanimous. Thank you. The next report is item 12, risk management and internal controls. So, Ian, over to you once again. This is a fairly standard report. Over to you.
Thank you, Chair. Indeed, it is. This is the report that we bring to each committee and each board. It's the pension fund risk register, and it just highlights the risks that we review within the 6 separate categories. There have been no changes to any of the scores in the quarter since the last time you've seen the report. There have just been 2 very minor changes in terms of the work that Kat and Boulash have been doing on the net zero climate strategy, and a little bit of movement on the risk 8 around the in-house AVC provider. A national framework is being scoped to allow funds to go through a tender exercise via the framework, which will be a real benefit rather than each fund having to do individual tenders if they are looking for a new AVC provider. Other than that, the risks have remained exactly as they were at the last quarter, Chair, but happy to take any questions.
Okay, Jeff.
Thank you, Chair. Yeah, I mean, members of the committee might recall, I think it was a couple of meetings ago, I did question whether there needed to be more detail or more specific reference to it. Sorry, this is in risk number 3. This is what I'm referring to. So the investments risk area, that there should be more recognition and specific mention of, the risk that the fund is running of ending up with stranded assets. So, obviously the way it's set out is you can read that into it, but I just felt that, and probably still do, given that it's not, the risk register has not been changed in this regard since I raised it before. I just wanted to highlight that again, that I feel it should be, more specific reference should be made, and to that particular aspect of the investment risk, and some commentary really on how that will be treated in the context of everything we've been talking about around climate change strategy, etc.
Thank you, Declan.
Yeah, just quickly, now that's something we agree with. Now that the climate strategy has been approved, it's one of the tasks on the action list to just sort of refresh those risks. We'll pick that up.
So that will happen. That will happen. So, Nick.
Could you add a specific, what happens if China invades Taiwan?
I think.
Okay, we'll have a risk register. We could be here for another 3 weeks if we go on like that. Yeah, there's so many risks out there. But yeah. All right. So if there is no one else with any register of the pension fund, and note the comments made, is that agreed? Right, that's unanimous. The date of the next meeting is the 16th of June 2023 at 9:30. We have no urgent items. Before we go into exclude the public and press, I just got one announcement. I understand that Matt Hand's final meeting, this is his final meeting. I think he's in the corner crying. As he will shortly be leaving the County Council at the end of March. Matt has supported this and other pension committee meetings for a great number of years, and I would like to pass on my thanks as chair, and on behalf of the committee, our thanks for his support, and wish him all the best in his new venture. Thank you, Matt. No, no, he's not. He's going. All right, so we're going to move into a private session, and hopefully the private session will be brief. The public are to be excluded during consideration of the remaining items in accordance with Section 100A4 of the Local Government Act 1972 exempt information. We now are going to move into private session for consideration of the items. So anyone in the public gallery, if they could leave, there is nobody, they've all left. So once the live stream is ended, we can consider the items.